like to welcome everybody to this session of Managing Your Money. The topic of the day is inflation, which is on a lot of people's minds these days and the past couple months and maybe even years. And so there's probably a lot to talk about. I'm going to share my screen briefly here to start us off, and hopefully you can see this. And this is a picture, a current picture of core PCE inflation, which is a little bit broader than CPI. And you can see, interestingly here, how inflation is above 4%. Hard to read the numbers on this chart. And yet the Fed's target is this purple line of about 2%. And we are, as you can see, way above target. So inflation looks visually elevated. I'm going to call on Adam. Adam, would you like to discuss what is going on with inflation and why it is this elevated?
Yeah, well, the inflation that we are experiencing now has been born over a period of many years, certainly the last 10 years, and especially the last 2 or 3 years. During COVID, there was an enormous fiscal expansion that happened in order to make sure that as many people stayed employed as possible, that as many people had spending money as possible, that businesses were able to stay in business. And that fiscal stimulus was financed by money printing on the part of the Federal Reserve. And we wrote letters back in 2020 when deflation was the big concern, that, this combination of fiscal stimulus and monetary stimulus is a surefire formula for creating significant inflation. And in fact, it's what Ben Bernanke talked about in his famous deflation speech in 2002 that landed him his job as Federal Reserve Chairman, where he talked about how the Federal Reserve had all the tools they needed to prevent deflation from happening. And they deployed all those tools during COVID. And so inflation started to accelerate at the end of 2020. It continued to accelerate throughout 2021. While the Federal Reserve continued to print money to stimulate the economy. And it wasn't until early 2022, when it was clear that inflation was totally out of control, that we saw the Federal Reserve start to put on the brakes a little bit. And Congress hasn't put on the brakes at all. I mean, there's still a massive fiscal deficit that continues up until this day. In fact, that fiscal deficit is accelerating. So that's why we have the inflation that we have today. And I think the Federal Reserve would like to bring it down, but whether they have the tools to do so and the will to do so and the cooperation with the people who are in charge of the fiscal spending to do so is I think, a big question mark.
That's a good point. And I just so happen to have a chart, not knowing that you'd go there, but this is, I think, an interesting chart of US deficits. And as you can see here, this, Adam, to what you talked about, this is the COVID era spending surge, right? Pre-COVID, the US government was running shockingly deficits of $500 billion to maybe $1 trillion per year going into the COVID years. And those were pretty flush years, economically at least. But then COVID happened, and you see our deficits balloon out from this $500 billion to $1 trillion level to a peak of over $3 trillion during the peak of COVID in 2020, and moderated a bit in 21 and moderated substantially in 22. And people believe that by 22, we were back at a $1 trillion a year annual deficit, which was where we were kind of circa 2019. And then to Adam's point, 2023 happened, or kind of unbridled spending by Congress has gone on. And here we are, shockingly, in an economy that is pre-recession, or certainly not in recession, with unemployment at sub 4% at historic lows, running a deficit of $2 trillion. And to your point, this is something that Bernanke has talked about, and maybe Milton Friedman most famously was the one to talk about that inflation is a monetary phenomena. And this would back up your point, Adam, that all this money sloshing around would likely lead to inflation.
Well, yeah, and it gets really dangerous when you have the monetary side of it, and then you've got this fiscal channel that's putting it out into the direct economy, right? Because we've seen other episodes before historically where we had a lot of monetary stimulus that did not result in price inflation because there wasn't that mechanism to really, we saw it in asset price inflation, but not in like goods inflation. But now that we have both the monetary stimulus side and the ongoing fiscal side of things, now we're actually getting that translation into the direct economy where we see real goods inflation, service inflation.
I think that's a good point, and I often believe that there are many root causes, and I will use the expression that inflation has many fathers and or mothers, to be fair, and so it's not just the deficit or the high levels of U.S. deficit spending, but I would argue that something else has been weighing on inflation or causing inflation to trend higher, and that is the recent increase in oil prices. And, oil, as you can see in this chart, has gone from, a low of, I don't know, the high 60s a barrel to, as oil futures to almost $90 a barrel. And the oil futures, or a shocking increase of about 30% in 2 months. Josh, would you like to talk about energy's impact on inflation?
Sure. I mean, energy stocks are a small percentage of the S&P 500, but it has an enormous outsized impact on the broader economy. You need energy to do everything, and as oil and gas prices climb, it acts, essentially as a tax on the consumer and on corporations, because it just makes everything just a little bit more expensive. And one of the things that has started to transpire over the last couple of years is in part and parcel with higher oil prices is the deglobalization of the economy that's really got kickstarted with the invasion of Ukraine. You're seeing closed gardens, let's call it, with Russia and with China, and China has exported deflation for many years, and the closed garden effect, where corporations, I should say, are shipping less product to China and China's shipping less product to the United States. Things that used to be really cheap, if you want to buy your widget from China, now you're going to have to buy it elsewhere, or maybe it's even made in the United States. And part of that has to do with is a result of higher energy prices, making it more difficult to ship stuff across the world. But more so, it's all about politics. It's about the world wanting to get more independence from other countries and less focused in on international trade, of which oil is a big part of that.
I think that's. I'm sorry, Adam.
I was wondering if I could just jump in here. In July 2021, we wrote a quarterly letter with trying to answer the question, is the current inflation going to be transitory or persistent? At that time, inflation was on the way up from 4% to 5%, on its way to, I think, more than 9%. And at the time, policymakers were saying it's transitory, don't worry about it. And we basically took the opposite side of that. And we listed a lot of the factors that we've been talking about on this call so far. Excessive levels of debt, record fiscal deficit spending combined with record monetary stimulus, deglobalization, rising energy prices, increasing wages, and dollar depreciation. So, I think this is a pretty good read and probably, worth rereading. Maybe we could put a link to it on the show notes when we're done with this.
I think that's a good point. I think those factors all contain. There are many fathers and mothers of inflation, as I was talked about. I think those factors are important. Josh, you brought up this idea of resource nationalism, right? And deglobalization, which are contributing. So yes, all these factors, wage pressures, energy that you talked about, Adam, the huge deficit spending, all these are contributing to inflation. And so we have this very inflationary environment, which we pointed out. As you said a while ago in one of our letters, but it is seemingly persistent, even though inflation is down from the peak. I don't think we ever argued that it would stay north of 9%, but we argue that it would be persistently higher and persistently above the very first chart that I showed, the Fed's long-term inflation target of 2%, which historically seems to be a very arbitrary target. I don't think there's any kind of science behind that 2%. Apparently, it was anecdotally my understanding. It was just kind of chosen out of thin air almost in the 1990s. I'm gonna segue to this other chart because I think this is interesting, and the headline is, energy price spikes do not necessarily cause generalized inflation. And this is a chart from, the end of the 70s to almost the current year. But in the 1970s, it did. And so this has been kind of sitting with me because, as you see here, the red line is CPI X food and energy, and the black line is crude prices, and you see that the correlation is in the 70s, in the great inflation of the 70s, at least it was very, very tight. And one of the lessons of the 70s was that as soon as inflation it went up, then it moderated, then it went up again, and then it moderated, then it went up again, and finally moderated. As soon as people thought inflation was beat, it reappeared again. And one of the things that could happen going forward is, even if inflation does come down for a period of time or goes below the 4% or even achieves the Fed's target, it might rise again. And certainly if energy prices are on the march higher, this does not bode well for calm inflation.
Yeah.
Thoughts on this?
Well, I think that's really important because I think it's what we're seeing right now, right? We had a big surge in energy prices last year, and we saw, we had a big surge in inflation, and then the government tried to manage that energy price down with releases from the SPR, and they were largely successful in doing that. And we saw energy prices come down quite a bit, but now a significant amount of the SPR has been depleted. You now have production cuts from the Saudis and Russians, and so supply is getting tighter and tighter, and we're seeing prices on energy starting to go back up. And what's happening? Inflation starting to tick back up. We had a lot of market participants, and a lot of, you see all these news stories earlier this summer about, the Fed won, right? The inflation fight's over. We're seeing this significant moderation in inflation, which we did see. But I think a lot of it was kind of smoke and mirrors because it was largely due to this energy price that was sort of managed lower, but not in a sustainable way. It's not because you had massive new resources coming online. It was because you had some sort of artificial resources that were being made available and managing the price down. And so as we see things tighten up, though, inflation's starting to tick right back up. And so I think this chart is it can sort of provide an important lesson. Because I think the market's been way too sanguine about inflation, and I think a little arrogant in thinking that inflation could be slayed so easily, so quickly. And history doesn't support that either. Inflation tends to be sticky.
It tends to be sticky, and the commitment to fight it is long lasting, and the governments at least historically tend not to have that persistent fight against inflation. We tend to give up or declare victory on a premature basis, and inflation comes back. And one of the worries today is that we'll get down to the Fed's target or close to it, and the Fed will declare victory and move on, and inflation will come back, and you'll see something like you saw in the 1970s, perhaps a spike up again in inflation. And I think you're right, and the elements are all present for inflation, as we've talked about. And one of the things that we touched on, but I'll share my screen on this, is wages, and which is also hard to, again, which bodes for higher inflation going forward, because wages are hard to bring down. Once inflation expectations are elevated in terms of wage expectations, they're hard to come down. This chart to me was fascinating because it basically showed a correlation between the percentage approval of labor unions in our country and basically the rise or the share of labor's of wages, the claims on a company's capital as a percentage of, or wages as a percentage of a company's earnings, I should say. And basically, you see here going back, 70 years basically, as the approval rating of unions go up, labor tends to grab more of the earnings power of companies, and vice versa. As unions become unpopular, then wages are a smaller part of companies' earnings. So interestingly, here today, now it looks like we reached a low of labor union unpopularity circa 2010, this during the great moderation of inflation of the last 15 years. And here we are today at union popularity or union approval ratings that match really almost the height of, shockingly, of union popularity in the 60s and 70s. And yet wages are still way below this. If this correlation holds, then wage pressures should go up, which should spell trouble for inflation.
If labor unions are going to be a significant driver in this sort of secular inflation period that we're in, I think you'd have to see a lot more unionization of this service sector. I mean, back in the 50s and 60s, we were much more of a manufacturing-based economy, and the manufacturing sector was unionized. And today, so much of the economy is based on service sectors too. So I think you have to see a lot, and we're seeing, we're starting to see some movements there. I mean, we've seen some efforts by employees at Amazon to unionize, and so maybe as the popularity of labor unions increase, we'll see more and more of the service sector start to unionize, and that could for sure put a lot of upward pressure on wages that we're not even seeing now.
Yeah, and anecdotally, we've seen a lot of unions, United Auto Workers. There have been airline unions that have been agitated. There's UPS union,
right?
Teamsters unions that have won serious victories in getting meaningful wage increases for their union members. You are right, Adam. We are this is somewhat, still much more of a service-based economy, and unions are relatively low. But the fact that unions are becoming more in favor and are using their newfound power and popularity to achieve huge wins, huge wage increases for their members is something that we haven't seen in a long time.
I mean, you're starting to see it more and more on the service side. I mean, Starbucks, who has historically been, rather aggressive in terms of providing healthcare benefits and other things to their employees. Even Starbucks is seeing some of their stores starting to unionize. So while they may not necessarily be as much of a manufacturing economy, more a service economy, but you're seeing a lot more, teachers, TAs, restaurants, what have you, start to unionize more and more. So you absolutely could see far more unions happening in areas of the economy that historically have been immune to such unionization.
I think I mean, this is a good way to sort of start a vicious cycle of upward pressure on prices, because you've got people feeling that squeeze now from this initial wave of inflation. And so that's, I think, feeding some of that strength of the unions and feeding into, some of those wins. And that's ultimately that'll feed through to those higher wages will feed through to higher prices, which will then cause a need for more union negotiations to continue to keep wages at a level commensurate with price increases. And so this could be one of those long-term drivers of inflation, and like to go along with things like demographics, which is actually that's not something we haven't even really discussed yet, but like there are some of these things some of these drivers of inflation that are more recent things, some of the fiscal and monetary stimulus that occurred during COVID and whatnot, and higher energy prices. But there's also some of the drivers that are really long-term structural things like demographics. And, I think that's going to be one of the drivers that really makes this inflation anything but transitory.
I think you're absolutely right, Matt. I mean, I think the aging population is part and parcel part of this wage increase that we're seeing. I think that anecdotally or directionally, when Social Security was incepted, it was three 3 workers for every retiree or something like that. The ratio was 3 to 1 or 4 to 1, and now I think it's 7 retirees for every worker or 6 retirees for every worker. So the whole population is completely shifted and aged, and that aging population really does not bode well for keeping wage prices lower. If you have fewer working age workers supporting a lot of retirees, supporting an older population, it tends to be inflationary.
Yeah, I think that there's not a full appreciation for some of these, I guess I would call big picture drivers. People tend to be focused on the big wave that we've seen, but I think it's some of these bigger, longer term things that are going to sort of keep it at that maybe not 9% level that it was at, but at an elevated level above where the Federal Reserve and other central banks are comfortable with.
Well, we've talked a lot about a lot of different aspects of inflation here, and maybe I'll come full circle since I started with Adam and give Adam a chance to sum up. Maybe you, Adam, you can sum up our thinking on inflation for our audience, please.
Well, I go back to that 2021 paper that we wrote. Is inflation going to be transitory or persistent? And it's only 2 years later, and we said it's persistent. I still think it's going to continue to be persistent. The inflation of the 70s, which you talked about, Billy, began in the late 60s after a long period of very low inflation. It was very low inflation all during the first half of the 1960s. And then it started to accelerate in the late 60s, and it persisted basically until it started coming down around 1981, 1982. But that persistent wasn't constant. It went up. There were 3 peaks. And, I think that's what we're going to see. We're going to see a series of peaks and valleys, but higher peaks and higher valleys. Matt said, I don't think we're going to, get to 9% again. I think we're going above 9% before this whole cycle is over. Not this year, maybe not next year, but, I think we have higher peaks to come that we have not yet scaled. I mean, we'll see, but that's my guess.
Double-digit inflation called right here. Ooh, write that down. December 6th, 2023. Adam called double-digit inflation. Woo!
That's a very bold call, Adam, and a great way to sum up our conversation. This has been a fantastic conversation and a great installment in managing your money on the topic, ever important topic that touches all of our lives on inflation. So thank you all for your contributions, and thank you all for listening today.
Thank you, Billy.